Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on yet another episode of Big C. I'm Manisha Gupta, and with me is Nigel Dsouza, back with your daily dose of commodities, currencies and cryptos. Hi, Nigel.
Well, hi, Manisha. Well, over the next half hour or so, we'll be joined by the head of energy research at MST Marquee to talk all about things crude, followed by HDFC Bank's Sakshi Gupta to take stock of the macro impact of Trump's tariffs. So both those two waiting for us in the next few minutes. But a quick check on global equities. Well, the stocks are coming off a positive session. All three indices logged in a session in the green. The street digested the US President Donald Trump's announcements of 100% tariff on semiconductor imports and chips, but not for the companies building in the United States. News of these levies came after Apple said that it plans to spend an additional $100 billion in the United States over the next 4 years. That's, in fact, on top of the $500 billion commitment the company made back in February. Week to date, the S&P 500 has gained 1.7%, the Nasdaq is up 2.5%, the 30-stock Dow has advanced 1.4%. It's a similar story that's unfolding in most of Asia-Pacific region, where stocks are largely trading in the green. However, back home, signs of trade are extremely muted. The Nifty is soft. It continues to hover around the lower end of the range at around 24,450. Today is the weekly expiry, so expect some volatility to pick up.
Well, that's about the markets, but let's shift focus to the crude oil prices. In the U.S., crude has extended its declines for a fifth straight session today as prices continue to hover around that 6-week lows. Inventories in the United States are down by 3 million barrels in the previous week, and prices at this point in time seem to be attempting a rebound, as you can see. The dollar index is down on Fed's rate cut bets. The greenback has declined 5% so far in the year 2025. But it's all about the crude oil prices, really. And Saul Kavonic, head energy research, MST Marquee, now joins us to talk about that. Saul, hi, thank you so much for joining. And it's all about crude and the Russian sanctions, really. What really is your take on that? We've seen secondary sanctions come in on India at 25%. So 25 and then 25, it is 50% at the highest range when it comes to across countries in the global markets there. Would you say it's much to do with the Russian crude, or is there more in play?
Well, most immediately, we have two counteracting impacts here. So the one is the anticipation of these potential secondary sanctions, which would mostly effectively target Indian buying of Russian crude. And we've actually seen a number of Indian companies actually scrambling to find alternative sources of crude to Russian crude over the last few weeks. But remember, this is coming on top of OPEC recently announcing it's going to unwind that final phase of the full 2.2 million barrel a day cut tranche from September. So you've got a bullish signal and a bearish signal, which is what's kept Brent pretty tightly within a few dollars of $70 a barrel over the last week. And keep in mind, the market is still very skeptical about if these secondary sanctions are actually going to be put into place and enforced in a tight way, because Trump's tariff negotiations and his comments on sanctions have been so volatile and can change from day to day. The market tends to take them with a grain of salt and is not necessarily fully pricing these sanctions actually coming into force and staying in force for a material period of time.
Mm-hmm. Hi, Saul. Good to see you. But, Trump's been talking about drill, baby, drill. If you could tell us, what is the contribution of the United States with regard to oil supply, globally? And where do you see this headed? Because, there are a couple of Indian companies that have base in the United States, case in point being the Welspun Group, and they have got more than $1 billion of pipe orders, all of this in the last 8 months or so, which is clearly telling you that he's walking the talk with regard to that. He's focusing on the transportation of oil and gas. So help us out with a rough number. Contribution coming out of the United States, where do you think it's headed? And it's realistic with regard to this drill, baby, drill, mantra that he's put out.
Sure. So the United States produces just under 14% or 14 million barrels a day of crude supply. And one of the key factors there is obviously particularly in places like Permian, there's need for more export routes of crude, but also gas. But Trump's drill baby drill approach hasn't actually been successful. And what we're actually seeing in the United States is while production is now at record highs, the rigs have started to be reduced. And that's because we've seen, on average, lower prices combined with supply chain impacts from the tariff wars. And these two things together actually seeing people looking to drill less. Now, it takes 6 to 9 months before we start to feel that drop off in production. But actually, US production is now forecast to stay flat or even decline heading into next year because the drill baby drill approach has actually been unsuccessful. The only place that's actually been drilling more has been OPEC. So the big winner out of this has been the Saudis and particularly the UAE, who are now putting more barrels into the market and taking market share away from America.
Saul, what is your sense in both these events? If US does come out and put those sanctions on Russia, where do you see the crude oil prices go? What is the probability of that happening? And if that does not happen and there are negotiations, as we've seen in various earlier instances as well, then where do you see the crude prices go?
So if these sanctions are put into force and actually work, you're going to take a few million barrels a day off the market, and that could see prices remain elevated, potentially approach $80 a barrel, because those barrels of crude, if they're not going to go to India, some of them will go to China, but China will actually struggle to absorb all of them, and that could leave some stranded volumes out of the market. That said, if that doesn't happen, overall, the market is facing a point of weakness from September. So OPEC, as I mentioned, is unleashing an additional 2.2 million barrels over the last few months. That will culminate in September. But that's just as the Northern Hemisphere summer demand season drops off. So you're going to see demand for crude runs drop off just as more barrels come to the market. So unless we see tighter sanctions or a geopolitical risk flare up somewhere around the world, we'll probably see downward pressure from September and October on crude prices. But they won't head too low because, as I mentioned, US supply is actually starting to decline. And so we are finding this kind of natural floor, probably around the $60 a barrel mark, where prices can't stay below that for too long without a significant impact on US supply, which will ultimately tighten the market in 2026.
Saul, so 60 is on the downside. What about on the upside, with regard to some lack of supply? Even when we had the geopolitical tensions that did come up, at that point of time as well, we couldn't get past that $78 per barrel mark. So do you think in the near term, $80, $85 per barrel, that is the near-term ceiling for crude oil prices? Would you be in that camp?
Yes, I would be in that camp. And that's because the markets have been crying wolf on geopolitical risk now since 2022. I mean, ultimately, Russian crude has kept flowing, Middle Eastern crude has kept flowing despite the wars, despite the conflict. And so the market's kind of sick of just putting political risk premiums on and then supply isn't impacted. We would actually need to see a conflict materially impact supply before we see prices move materially above $80 a barrel. I think sanctions just on the the Russian crude that India buys is probably of itself not enough to drive oil prices much beyond that. But if we did see, for example, another flare up in the Middle East, which actually impacted Iraqi or Iranian crude or the Strait of Hormuz, that's when you start to see price spikes that could take us back up above $100 a barrel. But right now, it seems like tensions in the Middle East have calmed down and staying that way. And so that's looking more like a black swan event than a likely scenario in the next 6 months.
Saul, I want to push for a couple of numbers, really. And my question is two-part. One, after all those geopolitics and wars and tariffs, have we actually seen the global demand and supply numbers kind of take a hit in any sense? And the second part is on what's your sense now then for the rest of 2025, the first quarter of 26 as well, on how do you look at the global demand and supply numbers?
So we're looking now where demand's currently about 104 to 105 million barrels a day. And that's only about a million barrel a day increase from 12 months ago, whereas supply has increased by over 2 million barrels a day. So the supply is increasing faster than demand. What we've still seen, however, is the market is structurally still looking tight. The curve is in backwardation. Oil still keeps coming out of storage rather than in storage. It's actually a sign that the market's been structurally tighter than many forecasters thought over the last 6 to 12 months. And that's still the case today. So the real test point comes from September when you get the seasonal demand roll off. On balance, we should see downward pressure on crude prices in the December quarter and into the March quarter of next year. But like I said, probably not going to be going significantly below $60 for a material period of time either. We actually are in almost a sweet spot of the market between $60 and $80, which works for many consumers, but also works for many producers. And we're seeing some stability there, which I think is actually welcome by a lot of market participants.
So I'll wind down the conversation with one more question. And this really is about India then, because even as there are secondary sanctions that the US president has been talking about, India really seems to be in the middle and square of it right now. So with the way the movement is right now, and US, of course, wants its crude to come to Asia, including India too, logistically and cost-wise, how efficient does that seem?
Well, every time we see these sanctions or even disruption of shipping routes, for example, because of what the Houthis have done in the Red Sea, it creates an inefficiency, but it doesn't impact crude prices usually more than a couple of percent. Uh, the issue with the Indian barrels coming from Russia is if you do see them come off, the biggest winner is actually China, which will now be flooded with more cheaper barrels of oil. But then it actually raises the price for everyone else in the market. Obviously, India would see the steepest increase because it's going from discounted Russian barrels back to slightly elevated global prices. India would have to take that hit. But it's, as you know, this is part of a broader trade negotiation with the United States. And it's very fluid. These things can change any day. Nobody knows what Trump's going to tweet tomorrow. And so the market's willing to actually look through a little bit of this and not assume that any sanctions package or tariff is necessarily going to stay in place for a long period of time. And the market's willing to look through that. And that's actually helping stabilize prices when it comes to the oil market.
Thank you so much, Saul, for joining in with all that sense about the crude oil prices, demand, supply, the geopolitical impact, and of course, on what really could happen in sense of movement of crude geographically. Appreciate your time with us today. But with that, it's time for a short breather on the show. On the other side, we will be joined by HDFC Bank senior economist Sakshi Gupta. Stay tuned.
Welcome back. You're tuned in to the Big C. Well, we have Sakshi Gupta, the Vice President and Senior Economist at HDFC Bank, who joins us on the show. Hi, Sakshi. Thanks a lot for joining in. Well, what an evening it was, right? Trump at least gave a heads up that something more is coming, so we're bracing for it. And it appears the worst case scenario is played out. I think we have seen peak Trump tariffs. At least that's what my gut is. Let's see whether or not that's true. That said, now we're dealing with the 50%. According to you, what kind of growth hit would it be to our GDP estimates, both direct as well as indirect? What would you quantify it at?
Sure. So thanks for having me on the show. As you rightly pointed out, I think last 24 hours have been very, very eventful. Look, when we are trying to, assess the impact of these tariff announcements on growth, the first point I want to make is, of course, the additional 25% tariffs are, they're still, something that can be negotiated down. They are not effective immediately. They are still, Trump is saying that it will come into effect after 21 days. But looking at, the impact on growth, we really have to be in a counterfactual, world where we are looking at different scenarios. We estimate that if these 50% tariffs stick, of course, there will be a direct impact on India's, goods exports. This could lead to, 40 to 50 basis point downward revision in the FY26 growth forecast that we have. There could be, more severe, second round effects that could play out both in terms of, capital expenditure plans this year, some of the MSME players in labor-intensive sectors, etc. There is still lack of clarity on, how these tariffs across different sectors are going to play out because certain sectors are still excluded from the initial 25% tariffs that were also announced. We would, at this stage, we are not currently revising down our GDP growth estimates for FY26. We are at 6.3% for the year, slightly below the RBI's estimate. There are a couple of reasons and assumptions that we are making here. Of course, one is that, we are working with the assumption that there will be some amount of bilateral negotiation that will happen and that we perhaps settle at a lower tariff rate than 50%, perhaps closer to, and aligning with some of the, what some of our peer countries have seen. Secondly, from a domestic economy perspective also, I mean, there are some offsets that one needs to factor in. I mean, the rural economy, the front loading of capital expenditure by the government, also on the monetary policy front. I mean, these could be meaningful, offset at least for this year. And finally, I think something we need to kind of consider now going forward is what happens to the performance of the rupee relative to not just the US dollar, but relative to a lot of our Asian peers. Just to give you a number, so far in FY26, the rupee has depreciated close to 2.5% vis-a-vis the dollar, but we have actually weakened much more, closer to 4% compared to a lot of our Asian peers, right? So the movement of the rupee also now becomes an important aspect when we are looking at mitigating some of the impact from higher tariffs in this economy.
Sakshi, just to summarize it, you said 50% tariffs can lead to 40 to 50 basis point of a downward revision, but at this point in time, you're not changing your FY26 guidance at 6.3%, correct?
Yeah.
Okay. You've talked about a larger sense of economy, but when you look at the sub-subjects here, and we are looking at gems and jewelry, textile, rice, even fisheries for that matter, as some of the segments which stand to take the biggest hit here, because US is a big market. How are you looking at it segment-wise then?
Right. So, you correctly pointed out, look, the largest four sectors in which we have, export exposure on the good side to the US include gems and jewelry, electronics, textiles, a lot of it is ready-made garments, and the pharma sector. Currently, from what we understand that, out of these sectors, pharma and, smartphones, etc., perhaps are excluded from the tariffs that the US has imposed. So at this stage, of course, gems and jewelry and the textile segment are sectors which could, take a hit because of the 25% tariffs that are coming into effect today. For larger players, I think that we could still, the impact could be lower. But I think as you move down the chain and look at some of the SME or MSME players in these segments, I think the ability to absorb the tariff costs or the tariff, general tariff impact could lead to, a moderation or a slowdown, given that the US market is, of course, very important in these segments. Apart from this, there are other sectors, for instance, shrimps, if you look, which is, the fishery sector that you talked about, or you look at things like leather and footwear. I mean, these are, again, sectors that are very, very labor intensive, dominated by a lot of, smaller players, where, again, there could be some impact of these, tariffs that are already imposed. So at this stage, the sector-wise story, of course, as I said, is very, very mixed for, bigger players and for segments that are excluded from the tariffs. Things are still, kind of holding on. But, from a macro perspective, look, the uncertainty around where tariffs settle in itself is something that is, going to weigh on planning in terms of hiring, planning in terms of capacity expansion, and in general, carrying out business. So, from a macro perspective, I think that is something that we need to account.
Sakshi, another important point, of course, is that both of these sectors, whether it's gem and jewelry or textile, are labor intensive as well. And the initial conversations from the representations of these sectors tell us that this is something that will perhaps need to be salvaged going forward. How bigger of a concern do you see that? And will those numbers start to trickle into overall economic numbers as well?
Oh, absolutely. Look, I initially said that at 50% tariff, the hit to GDP growth is 50 basis point. At 25% tariff also, I believe we will, see a risk of 20 to 30 basis point to our GDP growth forecast. I mean, this is kind of factoring in not just the direct impact from higher tariffs, but I think the bigger risk of a spillover to domestic manufacturing as well as hiring and the general labor market over the course of the next 1 year. So you're absolutely right that the big risk for me at this stage is clearly the spillover effect that can happen over the next few quarters.
All right, Sakshi, what can we do now, in terms of the action from India? Because President Trump is not relenting. 25% has become 50%. What do you think is the best solution for us? Clearly, we don't want, those agri-imports to come in there because, it affects a large part of our population. Do you think, the Indian delegation could do some kind of deal on maybe purchasing a little bit more oil, maybe some more defense equipment, and at least, get Mr. Trump back on the negotiating table and then see what works out? What would be your best case scenario?
Yeah, I mean that is broadly what a best case scenario or the hope that I'm currently working with. That at the end of the month you do have the trade negotiations that will revive with the US. I think that there has been talk of where India can make certain concessions to kind of get favorable trade deal outcome. However, that being said, I think there are of course certain spaces where it seems like they could be a little bit non-negotiable. Of course, the whole agri piece, the dairy product piece, etc. But I think that India could manage to, or we, in the best case, we would assume that we would be able to manage some concessions, as you said, on the oil front, buy a little bit more oil from the US, and spaces like, defense, etc. I mean, that would be ideally the best case scenario where we ultimately come out with a deal where our average tariff rate is closer to, 19-20%.
That was my follow-up question really on what do you think is the best case scenario, and you believe 19 to 20% is something that most Indian sectors can live with, because gem and jewelry says 10% is also quite bad because the margins only stand at 3 to 4%. When it comes to textiles, we have an import duty of cotton at 11%, so the raw material cost itself is on the higher side, with a very, very tight competitive market that we are looking at, with other competition already at around 15 to 19%. Would you say that the best case scenario perhaps could be slightly lower than 19, 20 even?
Right. I mean, look, the best case scenario in that situation can be that we end up with 10% tariff. But to be realistic, look, even at 19-20% tariffs, if, you talked about the margins and the space that Indian producers have in a lot of these sectors, ultimately it boils down to what is the tariff that your competitor is facing. Right. And if you look at a lot of the other countries, Bangladesh, Vietnam, Malaysia, Indonesia, for most of them, the tariff range currently is close to 19 to 20%, which kind of puts us on a level playing field. Right. So I think that our relative tariff differential comes into play here, not the absolute rate of tariff itself. Secondly, I think that something that we need to now consider is where does China's tariff ultimately settle? So currently, China is facing a 30% tariff. Of course, there are ongoing negotiations, etc. if India continues to enjoy a 5 to 10% tariff differential vis-a-vis China, who is in a lot of spaces one of our biggest competitors, right? And then I think that in certain segments, the impact for us would therefore be mitigated. So I think the China story is something that we also need to kind of factor in when we are looking at sector-specific, impacts.
Okay. All right, Sakshi, thanks a lot for joining in and giving us your take on how you see this entire Trump tariff tantrum play out and its impact on the Indian economy. We look forward to chatting up with you shortly. Well, on that note, though, we'll wrap up on this edition of The Big C. You stay tuned. More news and updates on the other side.